Hello and welcome to this webinar on alternatives to holding cash in your portfolios. It's never been so important to have income producing safe assets in your accounts, given that Donald Trump is unleashing a trade war and stock markets are falling. We've got a brilliant panel here to discuss cash alternatives. On my left we have David Coombs, who is head of multi-asset at Rathbones Asset Management. We have Jamie Irving in the middle, who is a fixed income manager at Aberdeen, where he manages the short-dated corporate bond fund. And we have Tim Foster on the end, who manages money market funds for Fidelity. And I am Sam Benstead of Interactive Investor. So money market funds are the most obvious alternative to holding cash in portfolios. So Tim, what are money market funds and what goes in them?
Sure. Well, hi Sam, and thanks for having me this morning. Yeah, so a money market fund is basically, it's the lowest risk. It's a fund, but it's the lowest risk kind of fund that we can make. So it essentially buys very short-dated fixed income instruments, and also a mix of kind of deposits with banks and sort of short-dated fixed income instruments. So it is a fund. It does have a very low level, but some level of kind of credit risk and interest rate risk, but really as low as we can make it. It's also kind of regulated type of activity actually, so there's fairly strict regulations around what you can put in a money market fund, but broadly speaking, as I say, fixed income and very, very short. So an average maturity, not more than 2 months, and typically around 1 month of those instruments. Everything's highly rated by credit rating agencies, so sort of mid-single A or better, and very liquid as well. We typically have about a third or 40%, say, of the fund maturing within each week. So, with a real emphasis then on kind of low risk as we can make it within a fund structure, and liquidity. I say it's a fund, so yeah. Other important point at this point, it's a fund, so you can put it, for example, in the stocks and shares ISA. It fits within. You're treated just like any other equity or bond fund, really.
And yields, what are the yields on money market funds at the moment?
So kind of comparable to what you get from comparable to the Bank of England bank rates, about 4.5%. At the moment. So pretty good.
David, the other real cash alternative is gilts, particularly short-term gilts.
Yeah.
So can you explain to us what gilts are and how they can work as a cash alternative?
Yeah, sure. So gilts are UK government bonds. So think of it as you're lending money to the country, if you like, to Rachel Reeves. That might make you feel comfortable or not. I don't know. It depends how you feel. But effectively, you're helping to fund government expenditure by lending money to the government to spend on defence, NHS, etc. Now, because you're lending to the government rather than to a company, it's seen as a low-risk type of investment. Arguably, it's slightly higher risk than just holding cash in a bank, but we could have a debate about that, and maybe we will as we go through the show. But generally seen as a risk-off, risk-free investment. Now, you can lend to the government over a period of 1 year, 2 years, up to 30, 50 years, in some countries even 100 years. And the longer the date of the government bond that you own, the more risky it becomes, and no doubt we'll come back to that as well. But in terms of short-dated gilts, less than 5 years or less than 2 years, they are reasonably safe alternatives to cash. They can still be moving price on a day-to-day basis, but they're highly liquid. You can sell them very easily. You get your money back very quickly. They're not locked up. No exits. So they're a really good alternative to cash that we use in my funds, for example. I also use in my own personal portfolio as well. So certainly something that should be considered, particularly today or at the moment, given yields are quite high. So yields between 4 and 5.5%, depending on what age to maturity you hold. So, and then you can buy them and then lock those rates in for a considerable amount of time.
And what is the main difference then of holding a gilt, a short-term gilt maturing in 2 or 3 years' time, versus holding a money market fund?
Well, with a gilt, you've got options. So you can hold it to maturity. So if you think about it, just like any other loan, you're lending the money, as I mentioned earlier, to the government. And in 2 years' time, the government will pay you back 100 pence on the pound. So you have a known end date, if you like. And if you buy that gilt today, say it was yielding 4%, or generating a income return of 4%. Again, I don't know how technical we want to go here for a second. You're locking that rate in for the next 2 years, effectively. It's a known return. So as long as you don't need that money within those 2 years, you know what what return you're getting, and you know when you get your money back. So it's closed-ended, if you like, as an investment. In a money market fund, of course, it's perpetual, because the fund may have some short-dated gilts in it. I suspect it may well do, but they will mature and they'll be reinvested. So the money market fund goes on and on, but I guess the yield will change from day to day and week to week and month to month. Whereas if you buy a gilt directly, you're locking in the rate at the day that you buy it.
So the money market fund would be more of a kind of instant access kind of product, as opposed to a gilt, which, as David said, lock your return in for the short run.
And Jamie, short-dated corporate bond funds behave more like money market funds, don't they, at least in terms of their structure? Can you explain what they are and how they can act as a cash alternative or a cash-like product?
Certainly. So to David's point, short-dated corporate bonds, when we talk about corporate bonds, it's an extra layer up in the risk spectrum. So you are getting an additional yield, which we call the credit spread, over and above underlying government bonds. So generally, as opposed to lending to Rachel Reeves, we're lending to large corporates that are perhaps having to invest in general corporate purposes or invest in new project, infrastructure, building new shops or platforms. And so that added risk from lending to a corporation, which is generally seen as riskier than the government, over and above the risk-free rate, can generate attractive yields of 5.5%, even 6%. And when we refer to short-dated corporate bonds, that universe generally applies to those with a maturity of up to 5 years. The difference between that and money markets fund is that's generally up to 1 year or even below 3 years. So we have a wide universe of up to 200 billion in terms of nominal bonds available. It is very diverse in terms of sectors, industries, and countries, and it covers a wide spectrum of different capital structures as well. So it's got an element of more credit risk than versus government bonds, in the sense that it has credit risk, and it also has a little bit more in terms of duration or sensitivity to interest rates than you would have from a money markets fund.
And would you consider that a cash alternative, or is that actually hunting for a bit more yield, so trying to generate more than cash but adding on a bit of extra risk there as well?
It has more risk than cash, absolutely. However, it does have good liquidity characteristics. If we compare short-dated corporate bonds, so the 1 to 5 year universe over the last 25 years, for example, it has outperformed cash for 18 of those years. It generally, the drawdowns versus an all-maturity bond or corporates fund, the drawdowns are much lower in times of risk-off or rate sell-offs. For example, in 2022, I'm sure the audience is familiar with gilts. It surprised a lot of people that gilt portfolios were sometimes seeing losses of 15 to 20%, when that is technically a risk-free asset. Now, when we refer to risk-free assets, we don't mean they're free from risk of drawdowns. We're referring to free from credit risk. Short-dated corporate bonds, the drawdowns were still significant. We saw an 8% drawdown in 2022, but the recovery was quite swift. You'd made that return by the end of 2023, and in the years surrounding that, drawdowns have generally been on an annual basis, where there have been negative, have only been small, and perhaps 0.5% or up to 1% previously.
So let's talk about that period in 2022. We saw inflation rise, we saw interest rates rise, and that led to bond prices falling. So that drawdown in short-dated bonds, 8%, that is a loss, but it's not as big as some of the other bond markets. What happened to money market funds during that period in 2022? Did they genuinely protect investors?
Yeah, money market funds are unusually about the funds we're talking about at this table. Yeah, generally kind of do better when yields kind of rise, because you accrue a higher yield each day, really. So the money market funds had sort of positive. Yields were low back then, so I think we probably did 1.5% or something up over the course of 2022. But broadly speaking, high yields are a good thing, because the risk profile of the fund is so low. The high yields are generally speaking a good thing for a money market fund.
And what about gilts then, David, in 2022? How bad was the damage for long gilts, and therefore how important is it to understand the difference between a gilt maturing in 20 years and a gilt maturing in 2 years' time? Yes,
if we just think back to the scenario, 2022, in the US, for example, the interest rate rises, as in the number of rises and the speed of those rises, and then you saw that kind of mirrored in Europe and the UK, was almost unprecedented. And so if you're, I talked earlier about how you lock a return into your gilt. Now, say you bought a 30-year gilt that, and to Tim's point, was yielding 1.5% at the time, but interest rates are suddenly at 4%, like cash is 4%, and you've got a 30-year bond that's only yielding 1.5%. Well, clearly that's not very attractive, and so the price has to fall until the yield rises up to cash. So you, in the short term, as in the daily pricing of those gilts, could be very, very volatile. You can very quickly lose 25-30%. Now, obviously, if you hold it for the whole 30 years, you will get the repayment, but not everyone has that length of time on their side, or thought they'd bought a risk-free asset and suddenly find it's down 30%, can come as a bit of a shock. So it is worth remembering that the longer you go in maturity, the much greater chance there is of loss. And I mean, it's a very simple rule of thumb, but if interest rates were to go up 1%, you could lose 1% per year in theory. I mean, this is very theoretical, and don't quote me on this, but you could lose 30% on a 30-year gilt on a 1% move. So if interest rates were to move 2, 3, 4%, you can see how those losses can go up. And you can now see long-dated gilts pricing at something between 30 and 40p on the pound. So when they repay, you'll get 100, so you get a big capital return, and which may be attractive. But that shows you how far some of those bond prices fell, because they're all issued at 100, and you've got many now pricing well below that 100.
One of the gilt trends we've seen on our platform is investors buying gilts that trade at a discount to the £100 redemption value, and maturing in Jan 26, Jan 28, October 26. So gilts maturing soon, acting as a cash-like alternative. But these are trading at a discount to their par value, and because there's no capital gains tax on gilts, that pull to par is tax-free. So actually, if you're holding those outside of an ISA or a SIP, you're generating a very attractive, cash-adjusted, tax-adjusted return. Why is that, David? Why have we got these gilts trading below par?
Well, these gilts were issued post the 2008 global financial crisis. If you think back to that time, central banks reduced interest rates to zero effectively. We had that nil interest rate policy for a number of years. So governments were able to borrow. It's hard to believe today, given what's happening, but they're able to borrow at literally 0.125%, whereas today you'd be issuing a gilt at north of 4%, right? So these are old gilts that were issued after 2008, probably between 2008 and 2022, and because of the sell-off you referred to earlier, the prices of those bonds fell below the 100 to reflect the fact interest rates had gone up, because obviously 0.125% wasn't very attractive when interest rates were going to 4. Excuse me. So there are a lot of these bonds, including those that you referred to, they're now currently pricing well below the 100. So if you think about it, you can buy that bond, you know it's going to pay you back in January 26. You know you're getting 100. You know what the rate is today if you buy it. It's a very attractive investment. I personally bought them from my own account because, as a higher rate taxpayer, I'd rather have the capital return from my gilt than have it in my interest-bearing deposit account with the bank that I use.
So interest rates are 4.5% today. How attractive is that as a return, something you might generate from a money market fund, given where inflation is and where you think interest rates and inflation could be throughout the course of this year and the next few years?
I mean, I think David said it earlier. I think interest rates are still relatively high at the moment. I mean, obviously the bank have cut rates 3 times, but they're relatively high. An important thing to note as well is the market is expected to fall quite a bit from here. So, if the yield on our money market fund is 4.5% today, the yield on a 1-year gilt is sort of 4.0, that effectively tells you that the average sort of cash yield over the next year, the market expects the average yield to go down from 4.5 to 4, over the course of the next year. So that's roughly speaking, if the average is 4, then that means that in a year's time the market expects sort of roughly 100 basis points more cuts from from the bank, and that's a combination of some of the sort of slower kind of growth indicators we had sort of in the second half of last year in the UK, a bit of a kind of confidence hit after the autumn statement, and then also more recently people getting a bit worried about the impact of the new US government sort of policies and particularly tariffs. So I mean that feels a little bit high to me in terms of cuts. I mean, I think the Bank of England have a relatively clear outlook compared to some of the other central banks. Actually, I think they probably do want to cut rates, and I think it's unlikely that the UK will retaliate much in the way of sort of retaliatory tariffs. So there should be a reasonably clear path to rate cuts from here. But on balance, perhaps I think there's a little bit more priced in, as in 100 bips of cuts is a bit more than I'd probably expect, roughly speaking.
And where does the rest of the panel think interest rates will be at the end of this year, and how do you invest accordingly to really maximise returns?
Well, certainly the events for the last few days have changed market expectations quite significantly and have made it quite volatile in terms of what the expectations from financial markets are for interest rate cuts, particularly in the US. The UK has remained broadly more stable, as Tim alluded to. There is around about 3 cuts priced for the Bank of England this year. Personally, I would think that's a fairly accurate assessment. We'd expect, given the underlying trends in inflation, the fact that actually real interest rates, so after adjusting for inflation, the last CPI print for February in the UK was 2.8%, so you're getting positive real interest rates at the moment, which suggests you've still got a pretty restrictive outright level of monetary policy. And I think the Bank of England is inclined to not be walking into a hawkish era whereby there are perhaps risks to growth, risks to employment with the ongoing hit to confidence from this tariff, these tariff headlines. So I think it's reasonable to expect that we could perhaps see 3 cuts this year. Where the picture becomes less clear is looking into 2026 and beyond. If these tariffs, become official and the world bears the full brunt of them, and company margins are eroded, underlying costs go up, there could be a persistent impact on inflation going forward. But I think in the short term, it's probably realistic to expect 2 to 3 cuts, certainly from the Bank of England, for the rest of this year, to defend against that potential damage to growth and employment going forward.
So longer term, if we had more inflation, interest rates may stay higher. Is this actually good news for these cash-like products, or are there hidden risks associated with that?
Well, yes, because if inflation's higher, then yes, the yields might stay high, but your real return will be lower. So yes, if inflation were to go to, 4%, say, and you're getting 4% off your whatever your cash investment was, then that's a real return of 0. So it depends on your own personal inflation, I guess. I think what's interesting, and I'm not going to make a forecast on how many cuts, because I just think at the moment it's impossible, I'll be honest about that. I think, and some of the reasons for that are as follows. I think you had the OBR during the spring statement cut its growth forecast from 2 to 1%. I still think that's hugely optimistic. It also is forecasting inflation at 2% in 2026. Now, if that was correct, then interest rates at 4 would seem incredibly high. To have a real return of 2% over inflation from cash would be historically, you probably know better than I do, but that's historically very high. So something's got to give. Something doesn't feel quite right. And why is that happening? There's a lack of confidence in the government's economic strategy, very clearly. The spring statement did nothing really to deal with that. So the Bank of England is stuck, because is this one-off hit to tariffs inflationary, or is it actually deflationary longer term? Because actually, if companies overseas are not going to export to the US anymore, they're going to look to export to the UK instead at cheaper prices. We just don't know. We don't really understand. We've not been here for 100 years, right? And we didn't have the internet 100 years ago. So we really don't know what the inflation impacts are. I think anyone who sits here says they do is probably not reading the tea leaves very well. So I think the Bank of England is probably sitting there going, we don't know as well. They can't say that, but I bet if you got them off an unguarded moment. So I think right now trying to forecast interest rate cuts is not something I'm trying to do. I don't think it's possible. What I also know is if gilt yields continue to rise, and the 30-year gilt this morning went to almost 5.5%, that drives a coach and horses through Rachel Reeves's buffer, if that's the right word. And so the cost of borrowing is going to push the deficit up again. We're not getting any growth, so the risk of recession in the UK, in my view, is increasing, not helped by the national insurance changes. Now, normally in a recession, you'd expect the Bank of England to be cutting rates quite aggressively. So there is risk here that you could get 4, 5 or 6 cuts, or 3 cuts of 50 basis points. I wouldn't rule that out either. And so I think you've just got to be prepared with the same old diversified strategy of your cash or gilts or corporate bonds, because I think there's a number of eventualities. And if we do get a deep recession, the corporate bonds, and we talked about the difference risk, it's called default risk. Now, I'm assuming in a short duration corporate bond fund, in investment grade bonds, that's much lower, but in other areas of the bond market, high yield bonds, etc., you could see the market's perception of that corporate default increase. So there's lots of moving parts over the next 12 months. So I do think you want to be very careful about the quality of the credit one is buying, and also be aware that rates could fall. There is a scenario rates could fall much quicker, but for an inflation shock, on the other hand, rates might not drop at all, which I'm not sure I've been particularly helpful. But unfortunately, all scenarios are pretty equally weighted right now.
Well, let's talk about a global recession if things become very bad internationally. Jamie, how secure is your corporate bond fund? What could it look like in the event of a global recession?
So, to David's point, when we talk about short-dated corporate bonds, in this fund we're referring to investment grade. So that's bonds that have a rating of BBB or higher. So it generally excludes high-yield bonds, and particularly bonds that we, through our research and analysis, expect to perhaps deteriorate high yield. It excludes those and is primarily focused on companies with very robust balance sheets, predictable earnings, and predictable cash flows. The other good layer about short-dated corporate bonds is because you're lending out to companies for 3, 4, up to 5 years, you can actually get quite good revenue visibility, forecasts of cash flows, and a good assessment of the robustness of their business models over that time frame. Now, that's not to say there isn't, of course, short-term volatility, and as we've discussed, the events ongoing right now are really challenging business models across the globe. Great multinational issuers that perhaps had diverse global supply chains are perhaps actually looking much weaker than they had previously, having been the most strong, robust areas in the market. However, there is that element of protection from having that 2 to 3 year period, as opposed to having to predict a 10, 15 or 20 year cycle. Generally what you see in the UK market is the long-term issuers, the ones that have the ability to borrow for 15, 20, 30 years plus, are those with very stable, almost boring business models. So electric utilities, gas utilities, even water utilities, although that sector in itself has been more challenged recently, and housing associations in the United Kingdom as well, which have a natural buyer base from insurance companies or institutional buyers. For us as active managers, and perhaps more of interest to retail investors, is this more diverse pool of various industrials, corporates. Banks are a significant issuer in the short-dated universe as well. So these are company issuers. They are naturally exposed to recession risks. We would naturally expect credit spreads to widen as a result of a reassessment of the overall risk to growth and to the impact that has on company balance sheets. However, it does have a bit of a natural de-risking from the fact that it is short dated, and you aren't having to predict and forecast these business models out for a longer time frame. There is also an element of duration hedge where there is some sensitivity to interest rates. So while there has been not quite the correlation that we've seen historically in terms of interest rates and credit risk, there is a natural protection from if the central banks do deem it fit to step in and have to cut rates aggressively in order to try and boost growth or stimulate demand. That can offset your weakness in your underlying credit spreads. And actually, we've seen historically short-dated corporate bonds. The returns from that excess yield, from that excess carry that you get over and above government bonds, has often been sufficient, even in times of recession, even in times of risk sell-offs, to generate positive, not just total returns, but actually positive excess returns, even over gilts.
And Tim, how secure are money market funds? In a worst case scenario of a global recession, what is the risk? What's the hidden risk, if there are any, in holding a large amount of cash in a money market fund?
I mean, I sort of started off by saying a money market fund is the kind of lowest risk kind of fund that we can make, and we do have some government holdings in there at the moment, and predominantly most of the time, most of the funds would be either non-financial corporates or banks, but we can shift the whole fund into governments as if there is a real sort of risk event. So I suppose another point I'd stress here is that these funds are actively managed, and clearly we are they're managed within a very tight sort of framework, but we're able to vary the maturity and vary the kinds of risks that we have within the fund in response to kind of financial and global financial stresses, really. So in a really extreme environment, we sort of shorten the fund up, have more of the fund just in really overnight deposits, and really de-risk the fund even more from its kind of low risk sort of starting point.
Are you pulling any levers at the moment with everything happening in markets to really shore up the portfolio, or are you not worried about what's happening in equity markets currently?
At the moment, I've been sort of shortening the maturity of the profile, but that's largely because, as I kind of said earlier, I think we're quite well. I mean, I take David's point that there could be, a severe recession in the UK and then a lot of cuts, but at the moment, it seems to me that we're maybe a little bit overpriced for cuts. I've just been shortening, even sort of 3 and 6 month yields have probably fallen by 20-25 basis points in the last couple of weeks. So I've just been, in response to that, I've just been shortening up the profile of the fund a little bit.
But there's been no cost on the fund. There's been no.
Oh, absolutely no,
down
absolutely
days.
not. No, there's been a little bit of a because yields have fallen. There's been a little tiny tick up in terms of the returns.
And historically, have there been periods where money market funds have faced liquidity issues or returns have dropped during really intense?
I mean, there was some intense stress on the industry in sort of 2007 and 2008. That was really the more institutional end of. So we'd also manage kind of what we call institutional money market funds. So therefore, largely kind of large corporate treasurers and sort of institutional investors like that. And yes, there was a certain amount of kind of liquidity stress, I'd say, at the worst periods in kind of 07 and 08. But the products did kind of get through that, and we kind of managed those flows, and that was fine and important as well. That never really touched the kind of retail end of the spectrum either.
The big headline at the moment is tariffs and equity markets falling. But what's been the impact on bond market? What have gilts done at the moment? What have short or long corporate bonds done during these difficult 2 weeks?
Well, it's been very volatile. The bond market's been incredibly volatile. Now, normally, one would expect in a big global macro event such as this, when equity markets are falling significantly, like 2008, you might expect government bonds to behave very well. In fact, on Liberation Day, if we can call it that, not sure I would call it that, but whatever, we'll stick with it. When equities first started falling, in fact, government bonds did perform well. In my fund, we have exposure to 6 or 7 different governments, and they were performing extremely well. And so it was kind of situation normal to a certain extent in an abnormal situation, but your bonds were going up and your equities were going down. It was a classic diversified strategy. That then started to shift over the next couple of days, and we've seen huge volatility in US government bonds. Monday, for example, when rumours of 90-day pauses on tariffs, we sort of a massive fall in bond yields, so prices going up, and then that proved to be a rumour, so then those gains were reversed. And last night, due to a number of technical factors, possibly linked to hedge fund trading, we saw US Treasuries sell off again and yields rising, and we've seen gilt market kind of following the US Treasury market as well. And I think, trying to explain it, frankly, I think it's for a book to write in a year's time, but my best guess at what's going on is that you're getting this kind of seesaw effect of market traders trying to understand, are these tariffs inflationary? Are they going to stick? Will there be retaliation? Will some countries retaliate and some countries won't? And trying to unpick all that, and of course, because going to my point earlier, we now have the internet and globalization. To suddenly shut that down is almost, although Donald's trying it, it's impossible. The interconnectivity, it's so hard to unpick all this, and I think bond investors are as fearful, and they're kind of saying to governments, we're worried about this global recession, therefore we're worried about deficits like in the US and the UK, which are already high, are going to get worse. And just like any other borrowing, when you think about it, if the person you're borrowing to looks like they're into a worse financial situation, you demand more interest for that borrowing. And I think at the moment the bond investors are saying, we're more concerned about you issuing more bonds because you're going more into debt because of recession, therefore we want a higher price for lending you the money. I think that's where we are. Well, we were when we left the office about an hour ago. It might be completely different this afternoon. But I think that's kind of winning out at the moment. But then on other days, you get a relief rally because if, for example, Jerome Powell cuts rates 50 basis points in emergency, but I'm not predicting that, by the way, but was to do that this afternoon, then bonds could perform incredibly well this afternoon. And so it's fluid.
Yeah, absolutely. And Jamie, Tim, anything to add on what's happening right now?
Well, certainly in the corporate bond market, you've got all the factors at play that David and Tim have been alluding to in terms of the underlying yields, but you've also got the addition of the credit spread. So that credit spreads adjustment, so adjusting for the credit risk for corporate bonds and for the increased fear within the market of potential recessionary pressures, those have been widening quite significantly. And it's important to remember they've actually been widening from near historic lows. When we were looking into February this year, the additional premium that you got from investing in credit risk versus governments was less than 100 basis points, so less than 1%. You really have to look back to pre-global financial crisis era before you look at credit spreads at that level. However, there was enough demand in the market at the higher yields that were available on offer to offset that relatively low credit spread. Being able to access investment grade credit risk that is generally very, very remote risk of defaults, very, very much expected to redeem at par at maturity. You're able to access that at 5.5%, 6%, even more than 6%. So that added as an almost natural hedge against any particular spread widening. Now, of course, we've had short-end yields react sharply lower. So there's been an interesting kind of tug of war between the total returns that have actually held up quite positively in short-dated corporate bonds from the underlying yields and interest rate exposure. However, credit spreads have been widening to partially offset some of that. Now, they've widened about 40, 50 basis points from trough to peak at the time of writing. That's probably not quite yet fairly pricing in this Trump unleashed scenario where these tariffs are set in stone and there is continued escalation and retaliation from the global economy. Realistically, that you'd expect that credit spread to widen further. So you have this interesting dynamic at play. It's, as a credit investor, we need to be careful where we're positioned, not only in the yield curve, and then certainly in our funds we've been overweight that short end, that sub 1 year part of the market where you get that natural runoff, pull to par and constant maturity. So that's the real added layer of liquidity that we can access. But we've also been cautious of where our exposure is in more globally export exposed names. Utilities, for example, is a sector that we're much happier to be invested in, where cash flows are generally domestically based, revenues are very predictable and stable, even if we're comparing cyclical sectors versus non-cyclical sectors. Actually, food retailers, domestic food retailers, tend to have a much more local footprint as opposed to an international distiller or drinks company that perhaps has been seen as defensive in the past, but actually has that export and that international exposure that puts it a little bit more at risk. So we'd certainly, we've seen lots of volatility in credit spreads, and I mean Monday was a day like I've never seen before, when they opened 40 basis points wider and at one point were 10 basis points tighter, i.e. Had improved, got more expensive on the day, and that certainly with the administration that we have in the US right now, we could expect more volatility like that in the days and weeks to come.
I mean, it's quite interesting. We talked earlier about 2022, and I think that's probably a sort of period that's certainly for longer dated bonds is on everyone's mind, because, and it pains me to say this because I do also manage bond funds, so I kind of have a one foot in this as well. But 2022 was a sort of difficult experience for bond investors because as we said earlier, because of the sort of inflationary shock, equities went down 20%, say, but long dated bonds went down 10%. Whereas based on the sort of previous sort of 20 years or so, you've expected to get a positive, like a hedge from your bond exposures. And I guess longer term bonds kind of hate two things. They hate kind of inflation, and we kind of had that kind of supply driven inflation shock in 22. But they also hate supply, and David was talking about that earlier. One of the consequences of sort of COVID, first of all the governments have a much kind of higher stock of debt. They probably added 20% of GDP just to their stock of debt, and they're still still borrowing a lot, still running very high kind of deficits. So yes, exactly. It's tricky, very, very tricky, obviously, for government bonds, particularly long dated at the moment, because you've got the the interplay of, well, are tariffs inflationary, and that could be quite different across different markets. It could be very inflationary in the US and maybe less inflationary, in the UK. And then you've also got this kind of, overlay with sort of supply as well, because I guess, one of the reactions that lots of countries are doing is they're going to increase, they're going to try and support their own economies by kind of increasing, government spending. Obviously the EU's doing extra spending on defence as well. You've seen sort of Australia, Canada doing kind of, more sort of government spending as well. So yes, just the interplay of all of those things is particularly making a long dated.
The government's talking about nationalising British Steel today.
Yeah, there you go, absolutely, yes.
First example of that.
Yeah. So it just makes that kind of particularly longer dated kind of bonds very, very kind of tricky to call at the moment.
And there's all this uncertainty, and higher yields actually improve the case for owning cash-like alternatives, particularly for new investors looking to move money into these assets.
Yeah, I think so. If I look at, I run multi-asset, so all of those asset classes in fixed income are open to me. But if I just talk, my fixed income portfolios at the moment are basically cash, because I'm getting 4% on my cash, short dated corporate credits, sort of less than 3 years, or even shorter dated than your fund, I guess, because I have that certainty, hopefully, of paying it back. We've done the right work on each company. And then sovereigns, we go from very short dated in Europe, some medium, some longer dated, because of those different scenarios I talked to earlier. I want to have some exposure to all of those scenarios and to hedge my bets to a certain extent. But where I'm not running a huge amount right now is a lot of credit risk, longer dated credit risk, to the point that was made earlier, because that lack of visibility, that risk of global recession, kind of overweighs all my other thinking, really, because if we have a deep global recession, there's been a huge amount of credit that's built up into the system. I mean, you talked about spreads being very narrow last year. That wasn't just in investment grade bonds, that was in high yield bonds, private credit, loans. And as always, you had a lot of yield chasing going on the last 2 to 3 years. And I do think there's a lot of private credit held in funds that maybe with investors that may not totally understand where we are. And if we think back to 08, when it was some of those debt instruments, collateralized debt,
CDOs.
CDOs,
Yeah.
thank you. Need a bond man with me, yeah. CDO squared, exactly. That was part of the problem, just the volatility of the pricing of some of these less liquid credit instruments, and that's kind of what I'm talking about. I do worry, that there's still something out there where that could have an impact on credit markets and undermine sentiment. So I want to hold high quality borrowers. I want a range of maturity dates, but definitely a bias to shorter dated, particularly corporate, and cash actually still paying you quite a good return, thank you very much, right now.
So let's move on to the Slido questions. Remember, you can submit more. There's a link in the description of the YouTube video. Question from Peter here. He says, with Trump tariffs now in full swing, are US and indeed global bonds want to swerve for now? So should you avoid US bonds and global bonds as an extension of that?
Very good question, Peter. I don't think you should. I think, when you're running a diversified strategy in multi-asset, that's what we're trying to do. We're trying to generate inflation plus returns and compound returns over the long term at various different risk levels. And global bonds, even today, have a place in that portfolio, because there is a scenario where the US Federal Reserve starts to cut rates, where I think I'm right in saying at the beginning of the year there was no rate cuts forecast in the US. I could paint a scenario now where you could get 4 rate cuts in the US. Again, I'm not predicting that, but it's very possible. And the US dollar is still the world's reserve currency for now. Donald's trying his best to move it to the euro, I think, or the yen, or maybe the renminbi. I don't know. That would really wind him up. But the dollar is still the world's reserve currency, and the US Treasury is still an institution that I think most people will be willing to lend to. Of all the sovereigns, it's still probably just about the least risky from a credit perspective. So I do think that there is a role for global government bonds. If we have a recession and rates come down quite quickly, I suspect you'll make some good positive returns from global bonds. But they will be volatile because of what's happening right now. Like Monday, I would agree. I've been doing this now 40 years. Monday was pretty strange. We could get more Mondays. And I think, we definitely have more Mondays, but more days like Monday's trading. So I think you buy global bonds, but you keep some cash because you'll have days where you can add more, I think is what I'm saying, and use that volatility.
I think from a valuations perspective as well, you've got to look at this, that prior to these headlines, the US was a very expensive market. And whether you're looking, equities, I know we're previously reaching new highs in the S&P 500, but also within credit, the credit spread on US corporate bonds was again at historic lows. That stability premium, I think, that the market attached to the US has, at least for the medium term, disappeared. There was, an element of US exceptionalism, as we defined it, where the US was seen to be this, real arbiter of free trade and the kind of poster child for capitalism in its purest form. And now that stability premium has gone. I think going forward there needs to be a natural risk premium attached to that perhaps wasn't there before. And as we were just discussing earlier, we're talking about buying on the basis of yield or of outright return. This is a market where it reminds you all that you have to consider risk premium. It is about the relative return you're receiving relative to your risk-free assets, so whether that's cash or whether that's government bonds. Actually, the opportunity cost right now of holding cash while it's still offering 4.5%, that's pretty low. You can afford to wait if you are concerned about material concerns about recession risk in risk-facing assets. I think going forward we do need to be wary of extreme valuations that were previously robust or seen to be robust countries, capital structures and issuers. And certainly I think we would look for opportunities in some of the big global names if they were to reach appropriate spread levels, which they're not 100 basis points over gilts. They need to be nearer 150 or even 200 perhaps in a more extreme environment. There's opportunities there, but right now the uncertainty is too high, the volatility is too extreme, and the valuations, in my opinion, haven't quite reflected that loss of stability premium from the US.
Tim, anything to add on US and global bonds?
I think we've covered it, but yeah, it's a good point. I think yes, if you are worried, your opportunity cost, as Jamie said, is of staying in cash or short dated assets. Your opportunity cost is low, so yes, there's some value in waiting it out. But these events do produce buying opportunities. I remember buying investment grade US corporates, absolute blue chip kind of companies in sort of March 2020 at unbelievably cheap valuations, really. So there's opportunity there. Provided you do it, incrementally in a sort of diversified way.
Yep. So Penny asks, what would be the best option for a large amount of cash, say from a house downsize in retirement? So I think she's thinking maybe money market funds versus short-term gilts. What would we summarise as the pros and cons of each option?
Well, obviously I can't give advice. And obviously don't know the individual circumstances of Penny. I think if I draw my own kind of experience, I have a lot of my cash in short-dated gilts at the moment because I mentioned earlier I'm a high-rate taxpayer, and owning low coupon or low interest gilts means that the vast majority of the return, 4.5%, will be in capital. So if you gross that up, for me, that's a very good way of holding short-term risk-free assets, I guess. It will depend on each individual circumstances, their tax affairs, everything else. So it's very hard to say. I think from a risk perspective, we've kind of covered it. Clearly cash in the right institution is probably the safest. And going back to 2008, there were some institutions, I seem to remember Icelandic banks were in vogue at one stage, so don't have your cash in Iceland. Well, they're probably fine today, but you have to be careful which bank you're using or which deposit institution you're using, but cash is pretty safe. Government bonds, despite the best efforts of the Chancellor, are still a safe asset. You will get paid back for short dated. I mean, money market funds, highly diversified across multiple issuers, I'm guessing. Diversification is always your friend in these scenarios. So a money market fund also would be appropriate, or a mixture of the three for most people. I mean, certainly that would seem quite sensible. I'll leave you to talk about credit and short duration credit, but again, it depends how long. It's always important to diversify. I think that's the key part.
I think I'd highlight that in investing in short-dated corporate bonds, I think for the vast majority of our audience, the only way to actually access that is through a diversified portfolio such as ours, which is invested across sectors, across various parts of the yield curve, to identify the areas where we most see value, and particularly in this environment, safety. The institutional nature of the corporate bond market means it's generally not possible for the average investor to be invested in a single corporate bond. You can buy gilts in denominations of whatever you want. You can buy £100 worth of gilts, you can buy £1,000 worth of gilts, or 10,000 notional. Corporate bonds, by nature, the vast majority of the market is 100,000 minimum investment. So for the average investor to really have access to that, you need to be with a fund that has the large pool of assets that has the ability to invest in these minimum denominations, as opposed to perhaps being overexposed. If you gather all £100,000 of what you have to invest in one single corporate bond, that's obviously far too overexposed than perhaps some people might want to be, although the same traits in terms of the taxation on capital gains and everything, the same applies to corporate bonds. So low coupon corporate bonds have the same tax advantages as gilts. It's just unfortunately not as accessible on a single item basis as the gilt market is, hence why pooled funds tend to be the most effective and really most available means of access to the market.
I think the thing to do is, once you step out of cash or short-dated gilts and you're looking at funds, look at their track record. I think it's like as if you're looking at an equity fund or a multi-asset fund, and look during periods of market distress. If you're worried about risk, how did they perform in 2022? If they go back long enough, how did they perform in 2008? that'll give you some idea of what the potential drawdowns are. And most of the time they recovered relatively quickly in some cases during those periods. And it depends on your own individual time horizon. If it was to be a 5% drawdown, if this cash is going to be there for 20 years, it's probably okay. But as I say, each individual will have a different view on that. But have a look at how these different instruments perform during those periods, and that'll give you some idea of the risk of taking part in those types of investments.
A question here on equities, but investing in safer FTSE 100, FTSE 250 shares with high dividend yields. So what is the difference between a dividend yield from a company and the yield you might get from a money market fund or a gilt or a bond fund? How can we compare those two things?
So with a bond or a cash deposit, you're lending money. Okay, we talked about earlier, you're lending money, you get paid interest and you get paid back at the end of the loan. Clearly when you're buying shares in an equity, you're buying ownership, as a part of the ownership of that company, and that entitles you to a share of the profits, and that's called a dividend. So clearly in a world of great global growth and good animal spirits and consumer confidence, one might expect, that obviously companies will differ from sector to sector, but generally speaking, in those type of environments, you might expect the revenues of those companies to rise or to be consistent, and for the profits to be consistent or rise, and for those dividends to be consistent or rise. Now, obviously, the opposite is true if one is thinks you're going into a global recession, or just a UK recession, for example, as I mentioned earlier. Then, in that scenario, the markets will start to think, well, actually, if unemployment was to rise, people are being taxed more, the oil price is very high, or council tax very high, they've got less money to spend, you might see revenues falling in some sectors, therefore profits are falling. They might reduce their costs to maintain profits. It will depend on a company by company basis. But you might expect profits to fall. You might see dividend cuts. When typically high yielding equities, when they have their dividend cut, that's quite painful in terms of the share price reaction. It can be quite a significant drawdown. So at the end of the day, there's no free lunches here. But certainly the last few days, those higher yielding stocks, or certainly at last Thursday and Friday, were outperforming because of the certainty of those high income dividend streams, profit streams. But what tends to happen when sentiment gets so negative and you go into a really distressed market, which we kind of got to on Monday, then kind of everything goes down because everyone just pulls their money out of the equity market irrespective. And you get that, what we call capitulation, where people just sell everything irrespective. It's no longer company specific.
Any other risks you'd highlight with equities versus fixed income and money market instruments?
I think we can boil it down to its very purest form, that bonds or debt is higher up the capital structure in company models and company balance sheets. So we as bond investors need to get paid first before equities, before dividends get paid. Now, what we don't have is exposure to capital gains from the long-term shared growth in profits and in margins. Likewise, we actually don't have exposure to the long-term capital losses. As bond investors, assuming there's no default in the underlying issuer, we are guaranteed to get paid back our investment at maturity, and we're going to get all our income and coupon payments along the way. That's of course absent a default, but before a company defaults, the equity generally needs to get eroded almost completely first. So you have that added layer of protection from being further up in the capital structure, and you've got the prospect of being guaranteed your principal at maturity. When I talk about credit spreads widening and tightening, if you shut your eyes and ignore the credit spread, you can lock in a yield of 5.5–6% on your bond, and if it's maturing in 4 or 5 years' time, you'll receive and achieve that yield all the way up to maturity. The credit spread is ultimately a mark-to-market move, which we, as investors in the fund, can trade and can act upon, and can assess relative values between one issuer which we may deem to be more attractive to invest in as a credit to lend to versus another. One might look particularly expensive, and we can gain an additional yield from swapping out of that credit into what we think is a better credit, offering us a more attractive yield, a more attractive return. But ultimately, it does have that added layer of protection of being further up the capital structure as bond investors and as credit.
Are there any rules of thumb for spreading a pot across different fixed income instruments? Tim, how many instruments do you invest in from which providers?
In terms of personal, I think probably, again, the answer would depend on your own circumstances and your own risk appetite, but as we've said, also your own kind of investing horizon. That really is the main thing, I think, when you're thinking about how much money how much do I need to move house next year? So maybe a sort of 1 year gilt would be an ideal sort of thing for that, or might I need some cash at any point? In which case a money market fund, or can I tolerate some risk on another sort of pocket and have that in a dividend paying equities or something like that. So I don't think that any kind of rule of thumb is going to depend on your own circumstances. I'm afraid that's a slightly kind of annoying answer, but diversification does work. It's about the only thing that kind of consistently works, in investing over sort of years and decades. So yeah, just think about your own sort of when you might need the money, and conversely, if you might not need some money for a while, how much kind of risk can you kind of tolerate with it? And then yes, have a mix of money markets, short-term bonds, equities.
And inside your money market fund, how many banks or how many instruments?
Oh yeah, so typically,
so
probably 50 different issuers typically, and then within that, range of different sort of maturity exposures and that sort of thing. So yeah, very, I think probably any mutual fund that you look at is going to be quite diversified.
Question here on the new ISA season and whether it's time to put more money into the market now. So generally, how aggressive are you positioned? I mean, money market doesn't apply here, but on the corporate bonds or the multi-asset side, how optimistic or defensive are you feeling today?
Are we allowed to pass? No. Look, I'll be honest, I have absolutely no idea what plays out in the next couple of weeks, right? Because you are trying to analyse a strategy that's being enacted by a president that, frankly, I don't think fully understands the impacts of the policy that he's enacting, and that's very dangerous. So, I always believe that the only way to invest is what we call pound cost averaging. That's adding incrementally to markets upon weakness, and as markets fall, add a bit more as it goes lower. And that's what I've always done professionally and personally, to be quite honest with you, because ultimately if we invest during the weakest days, we generate the greatest returns typically over the long term, assuming we invest in high quality businesses or bonds that are going to last through a cycle. So I think being brave and moving everything from black to red is completely foolhardy, or trying to call the bottom of the market. I said I've been doing this 40 years. I wouldn't even dream of trying to call the bottom of the market. Say, let's all in, so to speak. But I do think one has to take advantage when markets are fearful, because that's when prices are lower. Again, it links to your time horizon. How long have you got for it to play out? If it's 10 years, you've got 10 years to see if it works, right? If it's 10 days, well, that's a bit tricky. So I think what I'm doing in my funds is I am buying, adding to some of my equity positions almost every day, because I have high conviction there's businesses. I think they'll come through this the other end. In what shape, in what markets, not totally sure, but these are globally big businesses, and I haven't done it yet, but if I were to see the spreads that you were talking about earlier widen significantly, I would re-enter probably the corporate bond market at some stage. I don't think the prices are low enough yet. And when I do, I won't be, again, making a huge shift. It will be very small incremental steps on a daily basis. And that's kind of what I'm doing, is keeping that discipline every day, incrementally adding at lower levels and not trying to wait for the bottom. On the other hand, don't put it all in, because there could be some weaker days to come. Valuations are still not that cheap in the US equities, because they were quite high going into this, and in bond markets. So I don't think we're on sale yet.
Jamie, Tim, anything you'd add on that?
I think I'd make the same point in a slightly different way. For me, valuations have always been the key driver of long-term investment returns, and I think that applies to whatever asset class you're investing in. We were discussing earlier that valuations of cash right now, actually, your opportunity cost of holding cash, is not too punitive. You can, if you're really concerned about the current environment, you can be paid to wait. And at the same time, dollar cost averaging, which is actually, or pound cost averaging, which is, people have tend to refer to that as applying to equities. That can actually now also apply to bonds at the same extent. With the volatility that we've seen in interest rates, it's actually probably quite a sensible way to be invested in the bond market, rather than try and call the top or the bottom of yields, of credit spreads. Certainly we were looking at the market in the run up to this, felt that outright credit spreads were probably looking a little bit stretched. Our alternative assets of underlying gilts, which weren't offering too much of a premium, were relatively more attractive to a lot of areas of the market. However, some areas equally have sold off, perhaps unfairly, to the same extent as more exposed areas of the market. So some utilities have widened to the same extent as some consumer cyclical names. There's opportunities there, and as David alluded to, we would look to add slowly and opportunistically in those areas, without immediately making huge wholesale shifts while the uncertainty remains so high. And I think it's always important to remember that in every crisis, such as one now that we've faced, at the time there never feels like a way out of it. Yeah. This one is, you could argue, is slightly different. There's a very easy way out of it, and that is Donald Trump decides to make a huge U-turn on everything that he's promised thus far. There are also some natural institutional stabilizers. We've got midterm elections coming up. Mm-hmm. We, for the time being, also have an independent Federal Reserve. Whether we continue to have an independent Federal Reserve remains to be seen. But there are some natural stabilizers that could perhaps push back on this uncertainty and this volatility. As yet, we're not seeing real immediate liquidity stresses and pressures that we saw in the likes of the financial crisis, or even in the likes of 2020 during COVID, and to an extent in 2022 with the LDI-driven sell-off during the Truss-Kwarteng chancellorship. So there is, I think, certainly a case to making sure you can be positioned to top up opportunistically where areas can offer some compelling value.
And there was a bit of a clue, because on Monday, this day we were talking about, when there was this rumour that the tariffs would be paused for 90 days, you saw markets shift really fast to the positive. And you saw which sectors led it, which bond markets led it. So you kind of know what's going to lead the market out of this, because you had a practice session, albeit on a false premise, on Monday. So go back on Monday and see if you can, and it'll give you a bit of a clue.
But yeah, basic advice is the same, though, right? Isn't it? It's kind of, stay diversified and kind of move, buy stuff that's cheap.
It's not a time to be brave, is it?
No,
I think that's the point.
Unfortunately, that's all we've got time for. My thanks to all of our guests, and thank you at home for listening. I hope you found it as interesting as I did.